It's time now to get passive aggressive, where we track the shots fired in the battle between active and passive investors. Joining me now to discuss, Bruce Bond, co-founder and CEO of Innovator Capital Management, who, by the way, also co-founded PowerShares and is seen as one of the pioneers in the ETF industry. Bruce, great to speak with you.
Yeah, thank you for having me.
Now, we mentioned you're an ETF pioneer. You co-founded PowerShares back in 2002. You sold it to Invesco in 2006. You retired in 2009, but now you've come out of retirement to offer a new ETF product. Why?
Well, we think that right now there's a tremendous opportunity in the space. Although there's been a proliferation of a lot of different types of products, there really hasn't been a whole lot of innovation within the ETF marketplace. And so we think that there are some new products and new exposures that can be delivered to the table that would be really helpful to advisors and investors alike.
And one of your products is the Defined Outcome ETF. And if we look at the investment objective here, it's something that I don't usually see. It's to provide, or I should say, produce the return of the S&P 500 up to a predetermined cap, while buffering investors against the first 15% of losses over the one-year outcome period. That sounds like a structured product or an annuity. How does that even work?
Yeah, it's a mouthful. Well, really what it does, if you think of most investors in investing, you know, there's really no way to insure your outcome. We insure everything else, our lives, our cars, you know, our health. But investors really go into the market naked. You know, they don't know if the S&P is going to go up or if it's going to go down. What this allows them to do is to get in and to have an understanding of, if the market goes down, I would have some buffer or protection against the downside of the market, but I would participate with the upside of the market to a cap, to a predetermined cap, and they would have to hold it over a year to get that outcome. And we think that a lot of investors would be very attracted to that type of a value proposition in an ETF especially.
Which type of investor are we talking about here? Retail investors, institutional investors?
I think all types, to be honest with you. We're hearing from ETF strategists that are interested in providing more predictable outcomes in their portfolios that they construct with ETFs, as well as individual investors who maybe it's, you know, they've retired, they have a lump sum, they don't want to put it at risk in the market. You know, and sometimes I say, you buy the ETF, or I mean the S&P, you go in naked. You don't know if the market's going to be up, if it's going to be down. This gives you some control over what your outcome will be, and that's why they're called defined outcome ETFs.
Okay, so it sounds like this is something that has appeal in a market that's richly valued, like right now, or reasonably valued.
Right.
If and when we get a massive correction, though, what will be the selling point of a defined outcome ETF?
Well, it would be the same thing, because what happens is, if you get a correction, the caps, you know, you're limited on how much you can make, but the caps expand. There have been times in the past that it's gone up, you know, much higher than the market. And so really it is a value proposition. It's saying, if you can be protected from a downside exposure, but be capped on the upside, would you trade some of the upside to have some buffer to the downside? And most people are, you know, I think, are willing to do that.
Sounds like you're disrupting the insurance industry here.
Well, you know, we see products that are available in different places in the market that people are very attracted to the outcomes, you know, and to the value proposition. And we believe in the ETF structure and the chassis of an ETF and how efficient it is. And we think providing those types of outcomes in an ETF is what people are interested in, and that more and more products will be delivered, you know, in the ETF chassis through time.
So this is like a new wave of the smart beta ETF revolution. I want to get a sense from you, your outlook here. What inning are we in when it comes to innovation of ETFs, and what inning are we in when it comes to asset growth?
Well, I think as far as smart beta goes, I think we're probably still in probably the 5th to 7th inning, you know, with smart beta. You know, I think that we'll continue to see things just like in the mutual fund industry. You know, everyone has both their growth and income fund and their same iteration or their thought on why it should be how it is, or the strategy to produce these outcomes. As far as assets go, I think we have a long way to go on assets on the ETF side, to be honest with you. I think as the mutual fund chassis will continue to move forward and move over to ETFs, because it's just so much more efficient for those investors. And I think that will take a long period of time. It will never go away on the mutual fund side, but I think they'll continue to eat away their assets.
So second or third inning?
Yeah, probably maybe the 4th inning.